That flashing red you're seeing on your screen? It isn't just a bad day on Wall Street. It feels more like a warning shot. The tremors we're all feeling in the market right now could be the precursors to something much bigger, an event that's been building for over a decade. While the mainstream media tells you to just ride it out, a few outspoken economists are sounding a much more dire alarm. They're not just calling for a correction, they're forecasting a major crash in 2025 or 2026. Some, like the controversial economist Harry Dent, have thrown out some frankly terrifying numbers, predicting potential drops of over 80% in the S&P 500. Now let's be crystal clear. That is an extreme outlier forecast. Most analysts on Wall Street are not predicting that level of doom. The current consensus sees an elevated risk for a recession, with odds around 40% by late 2026, but they expect a slowdown, not a total collapse. The truth, as it often does, likely lies somewhere in between. But here's the question you have to ask yourself. What if the outliers are even partially right? What would a 30%, 40%, or even 50% drop do to your retirement account? For those of us at or near retirement, that's just not a risk we can afford to take. The smartest investors aren't panicking. They're preparing. They understand that the risks in today's market are fundamentally different, and in many ways more complex than what led up to 2008. So today we're going to look at the data, not the drama, and break down exactly why the risks are so high. And most importantly, I'm not leaving you with just fear. I'm going to give you a concrete plan, 3 specific high-yield dividend stocks built to be fortresses for your capital. These are companies designed not just to survive a storm, but to keep paying you quarter after quarter, while others see their nest eggs vaporize. This isn't about panic. It's about preparation. To understand the storm that might be on the horizon, we have to see how it formed. This isn't something that happened overnight. It's the result of more than a decade of unprecedented economic policy that has painted us into a very tricky corner. There are 4 factors that make today's situation so unique. First, we've had a long period of massive asset inflation. After the 2008 crisis, the world's central banks, led by the U.S. Federal Reserve, pumped trillions of dollars into the financial system and kept interest rates near zero for years. The goal was to encourage growth, but it had a huge side effect. It inflated the value of nearly everything. Stocks, bonds, real estate, all of it was lifted by a massive tide of artificial liquidity. Think of it like this. The market was a patient recovering from surgery in 2008. The Fed didn't just give it medicine. It put it on a 15-year steroid drip. The patient looks huge, but it's not all real muscle. It's bloated and unstable. This has led to elevated valuations, and while some think strong earnings can support these prices, others warn that pockets of the market look like a bubble. The second, and maybe the most critical factor, is the mountain of debt we're sitting on. The scale is simply staggering. In the United States, government debt to GDP is hovering near levels we last saw after World War II. Back then, a booming post-war economy and a young population helped us grow our way out of it. Today, we face slowing growth and an aging population. And it's not just the government. Corporations loaded up on cheap debt to buy back stock instead of investing, and households took on huge mortgages. This is a key difference from 2008. Back then, the problem was mostly in the housing market. Today, the debt is everywhere. It's systemic. That kind of leverage makes the whole system fragile, where one small shock can trigger a cascade of defaults. Third, we have the Federal Reserve's dilemma. For a long time, the Fed called inflation transitory while it was heating up. By the time they acted, they had to slam on the brakes, hiking interest rates faster than any time in modern history. This creates a no-win situation. If they keep rates high to fight inflation, they risk crashing the debt-heavy economy. If they cut rates too soon to save the economy, they risk inflation roaring back. As of late 2025, they've begun to cautiously cut rates, but they are walking a tightrope with no safety net, and a policy mistake is a very real risk. Finally, the government's toolkit is more limited this time. In 2008, the government had a policy bazooka. The Fed could slash interest rates from over 5% all the way to zero, and the government had the borrowing capacity to unleash huge stimulus. Today, That bazooka is low on ammo. With rates already coming down from a lower peak, there's less room to cut in a crisis. And with national debt so high, another multi-trillion-dollar bailout would be politically and economically difficult to pull off. This means if a crisis does hit, the government rescue may not be as powerful. For the first time in a long time, we might be largely on our own. I know that all sounds incredibly scary, and it should be taken seriously. Hearing this can make you want to sell everything and hide the cash under a mattress, but panic is never a strategy. Preparation is. As Warren Buffett famously said, "Be fearful when others are greedy, and greedy only when others are fearful." While many are still chasing high-flying stocks, the smart money is getting strategic. This isn't the time to run for the hills. It's the time to build your ark. It's time to shift your focus from speculative, high-growth stocks to battle-tested, resilient, income-generating companies. We're talking about defensive stocks. These are companies that provide things people need and buy no matter what the economy is doing. They are the bedrock of a stable retirement portfolio. In a crash, your number one priority is preserving capital. Right behind that is generating income. The three stocks I'm about to share excel at both. They aren't flashy, but they dominate their industries, have fortress-like balance sheets, and most importantly, have a long history of not just paying, but consistently raising their dividends through every kind of market. They'll pay you to wait out the storm. Let's build your ark, starting with plank number 1. There is probably no brand on earth more recognizable than Coca-Cola. It's the definition of a global consumer staple. The company operates in over 200 countries, and people don't stop drinking Coke or Dasani water just because the market is down. This creates an incredibly stable and predictable river of cash flow. But what truly makes Coke an essential defensive holding is its commitment to shareholders. Coca-Cola is a dividend king, a title reserved for companies that have increased their dividend for 50 consecutive years. In Coke's case, it's actually for more than 60 years. Think about that. Through the stagflation of the 70s, the crash of '87, the dot-com bust 2008, and the pandemic, Coca-Cola has always given its shareholders a raise. That is the kind of reliability your retirement needs. Looking at the numbers, Coca-Cola offers a healthy dividend yield. But the key safety number is the payout ratio, which is the percentage of profits paid out as dividends. Coca-Cola's is in a very safe and manageable range, meaning its dividend is well covered by earnings. There's plenty of cushion to keep those payments coming. During the 2008 crisis, while financial stocks were imploding, Coke's business held up remarkably well, and its dividend checks not only rolled in, they got bigger. Investing in Coca-Cola isn't about hitting a home run. It's about ensuring you stay in the game. It is a blue-chip anchor that provides stability, reliable income, and the peace of mind that comes from owning one of the most durable businesses ever created. If Coke is the king of beverages, then our second stock, PepsiCo, is the emperor of the entire pantry. Thinking of PepsiCo as just the other cola is a massive misunderstanding of their business. PepsiCo is a diversified global powerhouse. We're talking about Frito-Lay, with brands like Lay's and Doritos that give them an iron grip on the snack aisle. We're talking about Quaker Foods, a breakfast staple, and Gatorade, which dominates sports drinks. This diversification is PepsiCo's superpower. If drink sales slow, the snack division can pick up the slack and vice versa. It creates a balanced business model that's even more resilient to economic shocks. People might cut back on a fancy dinner, but they're still buying chips and oatmeal. Like Coca-Cola, PepsiCo is dedicated to its shareholders. It is a dividend aristocrat, a member of an elite group of S&P 500 companies that have increased dividends for at least 25 consecutive years. In fact, PepsiCo has raised its dividend for over 50 years, proving its commitment through every imaginable economic cycle. As of late 2025, PepsiCo also offers an attractive dividend yield, and its payout ratio is in a healthy, sustainable range. This indicates the dividend is not just safe, but has room to keep growing. In past downturns, including 2008, PepsiCo stock has proven its defensive nature, holding up far better than the broader market. By adding PepsiCo, you're not just duplicating your holdings. You're owning the two undisputed titans of consumer staples, forming a powerful defensive core for your portfolio. Our third and final stock is from an equally defensive sector, healthcare. People don't stop needing medicine when the economy is in a recession. This makes healthcare one of the most reliable places to be, and within that sector, AbbVie stands out. AbbVie is a giant biopharmaceutical company behind some of the world's most important drugs for immunology and oncology. Its products are essential, demand is inelastic, and strong patents create a powerful competitive moat. Now let's be precise about AbbVie's dividend history. AbbVie was spun off from Abbott Laboratories in 2013. Abbott Labs is the true dividend king in that family. However, AbbVie is a member of the S&P Dividend Aristocrats Index, an honor it holds because it has continued the long legacy of dividend growth it inherited from Abbott. Since becoming its own company, AbbVie has supercharged that legacy, increasing its dividend by over 300%. What makes AbbVie so compelling right now is its dividend yield, which is significantly higher than many other blue-chip stocks. And despite that high yield, analysts currently view the dividend as sustainable. The company's payout ratio is at a manageable level, meaning it has enough cash flow to cover its payments. For years, investors worried about AbbVie's reliance on its blockbuster drug Humira, but the company has executed brilliantly, developing new blockbusters like Skyrizi and Rinvoq that are now generating tens of billions and securing its revenue stream for years to come. In a crash scenario, a stock like AbbVie offers a powerful combination of a non-cyclical business, a high-yield income stream, and a demonstrated commitment to shareholders. It's the perfect complement to the consumer staple giants, adding diversification and a serious income boost to your portfolio. So, let's recap the plan. We've built the core of our financial arc with 3 pillars of stability: Coca-Cola, the unshakable beverage king; PepsiCo, the diversified food and snack empire; and AbbVie, the high-yield healthcare fortress. Each operates in a defensive sector, has a long history of rewarding shareholders, and has a balance sheet built to withstand a storm. But remember, no single stock is a magic bullet. These 3 should be considered the foundation, not the whole house. As you review your own portfolio, consider other high-quality companies in defensive sectors like utilities. For those who prefer broader diversification, look at dividend-focused ETFs like the ProShares S&P 500, Dividend Aristocrats ETF, NOBL, or the Vanguard Dividend Appreciation ETF, VIG. These funds give you instant exposure to a whole basket of dividend-growing companies. The most important thing you can do right now is have a plan. Don't wait for worried whispers to become panicked screams. By then, it's too late. Look at your holdings. Ask yourself how much is in speculative bets versus stable income-producing assets. Rebalance now, while you still have the chance. The economic storm clouds we've discussed are real, but the headlines and market noise are designed to make you react emotionally, to panic sell at the bottom and chase stocks at the top. Panic is not a strategy, preparation is. By understanding the risks and calmly positioning your portfolio in strong, resilient, dividend-paying companies, you are taking control. You're building an ark instead of being swept away by the flood. You can not only survive a downturn, but you can use the reliable income from these stocks to reinvest at bargain prices, setting yourself up for incredible wealth on the other side. Don't be fearful. Be prepared. I invite you to continue delving deeper into the world of finance and business. Here's another video and a playlist, one step at a time.